So your microphone and your camera will not be available to the seminar. And all your questions, we would request you to post to the Q&As. And the chat will be disabled. And we will also please request you to put your name, affiliation, and country before your question. And if you have any preference, please indicate which presenter your question is intended for. The recording of this seminar, this event will be recorded for internal IMF purposes only. It's an off-record conversation, and the recording will not be used publicly. Thank you very much. I would now request the Director of ATI, Mr. Sukhwinder Singh, for his opening remark. Thank you very much, and over to you.
So good afternoon, good morning, ladies and gentlemen. A very warm welcome to this high-level policy dialogue on inequality, developments and policy challenges in the post-COVID environment. This dialogue has been organized by the IMF's African Department in conjunction with the IMF's Africa Training Institute, which is based here in Mauritius. Now, even before the pandemic, sub-Saharan Africa was not converging in income with more developed countries as much as other regions were. And the pandemic, followed by the war in Ukraine, has exacerbated these differences, as well as deteriorated in-country inequality. And at the same time, the policy space to respond is severely constrained across sub-Saharan Africa in many of the countries, with high debt, low revenue bases, all combined with seriously declining aid flows. So given this backdrop, this dialogue on policy responses to inequality couldn't be more relevant or timely. In this first day, we're going to take stock of trends in inequality globally and in sub-Saharan Africa. And then we're going to be looking at the policy responses in the region. Tomorrow, we're going to be turning to country experiences in policy responses in trying to reduce inequality, and looking at both lessons from Latin America. There are some important lessons there for sub-Saharan Africa, but also some of the great work that's going on and success in several countries across sub-Saharan Africa. For this important policy issue, I'm really pleased that the IMF was able to convene some of the leading thinkers and policymakers on inequality. You're going to hear today, first of all, from the IMF's Deputy Managing Director, Antoinette Sayeh. Then we will turn to Professors Ferreira and Osai from the LSE and the University of Ghana, respectively, and then Peter Kamerlingen from Oxfam. We'll then move on to one of the World Bank's foremost experts on poverty and equity issues, Gabriela Inchaust, and she will share her views. And I'm very pleased that one of the IMF's own experts, Rodrigo Cerda, who's a division chief in the IMF's Fiscal Affairs Department, and actually a former policymaker, a finance minister himself, he's going to be moderating the discussion. Inequality is a key issue across the IMF's work on lending, surveillance, and capacity development. And the fund's doing a lot of analytical work in this area. Here, I'm just going to highlight that here at the Africa Training Institute, we've been doing a lot of training on this topic. We've been running several training courses for many African officials on inclusive growth, gender equality, and macroeconomics. And I'm just very pleased to announce here that we're about to launch a work stream on capacity building on climate change, which were extremely important and an aspect of inequality. And we are going to, we will be pioneering some of that work. And I encourage you to check out the information about all this training. Now, with that, it's a great pleasure. Please allow me to introduce IMF Deputy Managing Director, Antoinette Sayeh, who will deliver opening remarks. And of course, anyone who knows Antoinette, she's extremely well known to those determined to address growth and inequality in sub-Saharan Africa. Dr. Sayeh has been IMF Deputy Managing Director since March 2020. She was the director of the IMF's African Department from 2008 to 2016, and that was after a long period of 17 years at the World Bank in various positions of leadership. Dr. Sayeh also has been a policymaker. She served as finance minister in post-conflict Liberia under the government of Ellen Johnson Sirleaf, and she's been a distinguishing visiting fellow at the Center for Global Development. So over to you, Deputy Managing Director.
Thank you so very much, Sukhwinder, for that kind introduction. And thanks to everyone here today for joining us. A very good morning to everyone. Good afternoon to those of you in Mauritius and elsewhere other than Washington, and a very warm welcome. So it is really my great pleasure to open this important and, as Sukhwinder mentioned, most timely event on inequality. Now, as we all know, our world today is confronting multiple challenges, ranging from heightened geopolitical fragmentation to mounting concerns about sovereign debt in many countries and a cost of living crisis in virtually every country. And these challenges are creating even greater urgency for policymakers to tackle issues around reducing growing inequality. And this is particularly so for sub-Saharan Africa, as Sukhwinder also indicated. And now, even before the COVID-19 pandemic, inequality within African countries was the second highest in the world after Latin America. The pandemic exacerbated these pre-existing inequalities in several ways. First, within countries. We know that the pandemic disproportionately affected low-skilled informal sector workers, especially from the services sector, with women and youth bearing the biggest brunt. Second, inequality also increased between countries in the region, depending on their degree of resilience and capacity to respond to the shock. And finally, as Sukhwinder also mentioned, sub-Saharan Africa is expected to rebound from the pandemic more gradually than the rest of the world. Now, coming on top of the pandemic, the spike in food and energy prices stemming from Russia's war in Ukraine have further aggravated these inequalities. Food insecurity is of particular concern because food represents a larger proportion of the consumption basket of low-income households, and food insecurity was growing before the current crisis, with at least 35 million people in Africa having become acutely food insecure over the past 2 years. And in the near future, the effects of frequent climate shocks will further amplify this divide. In fact, sub-Saharan Africa is the most vulnerable region in the world to the effects of climate change, with the majority of the population living in rural areas and depending on weather-sensitive activities such as rain-fed agriculture. Sustained inequality can also leave long-lasting scars and undermine economic, social, and political stability. For instance, schools in sub-Saharan Africa were closed for much longer than in advanced economies, contributing to a widening gap in learning outcomes and thus weighing on medium-term growth. We know that the effect of school closures is stronger for children from poorer households and girls who are at a higher risk of dropping out. This deepening inequality in access to education is likely to slow down intergenerational mobility and perpetuate the divide within countries. So in sum, the divergent recovery paths between Africa and the rest of the world and within African countries may result in permanent fault lines, jeopardizing decades of hard-won progress in reducing poverty and gender disparities and making reaching the SDGs ever more difficult. Which is why we need to act now. And I am most pleased that we have gathered today together to discuss policy options for doing so. There is, of course, no one size fits all, but I will highlight 3 broad principles that I urge you to consider in designing policies to address inequality. First, in the current difficult economic and political environment, we must ensure continued support for the most vulnerable. Recent shocks confirm the importance of strengthening countries' social protection systems. Across the world, we have seen evidence of the positive impact and cost effectiveness of social protection interventions that contribute to poverty reduction, human capital development, job creation, and resilience in the face of shocks. Tomorrow's discussion will make clear that several African countries have made important progress and innovations in strengthening their social protection systems, including during the pandemic. But much more remains to be done. And as we recover from the shocks, any new strategy to foster long-term sustainable and inclusive growth needs to prioritize the immediate needs of the most vulnerable. Second, reducing inflation is essential, as inflation is, after all, a tax on the poor. The current inflation spike we are observing in the region is mostly driven by external factors, namely high global food and fuel prices and supply-side disruptions, some of which predate the crisis. Where monetary policy tightening is necessary, it is important to strengthen monetary policy frameworks to ensure the effectiveness of policy moves. Third, countries must continue reforms to enhance resilience to shocks and address the underlying drivers of inequality. There are various aspects of inequality: income, gender, health, economic opportunity, all of which are closely related and mutually reinforcing. So policymakers will need a comprehensive approach. Fiscal policy has a key role to play. For instance, pre-distributive policies can help level the playing field before people enter the labor market through the provision of public education, health services, and basic infrastructure. And redistributive policies help correct inequalities. For instance, through progressive income tax and social assistance to help people cope with life events. Digitalization can also help, as we will hear at the conference tomorrow, notably in facilitating access to finance and efficient delivery of income support. I, of course, fully recognize that in the current challenging economic environment, many countries will not be able to address their needs alone. The international community has a key role to play in helping them reduce inequality, and this includes the IMF. And since the start of the pandemic, the fund acted rapidly to expand our financing support, including through the $650 billion SDR allocation, and we facilitated additional debt relief. The fund is gearing up to roll out our new long-term financing instrument, the Resilience and Sustainability Trust, to help countries build resilience against climate change and future pandemics. We've also begun to integrate gender into our core activities of surveillance, lending, and capacity development. And our board recently approved a gender strategy aimed at further mainstreaming gender into our work. Indeed, we recognize that reducing gender disparities goes hand in hand with higher economic growth, greater economic stability and resilience, and lower income inequality. The IMF is also enhancing its analysis, policy advice, and training, as Sequinder also mentioned, and in the area of inequality and inclusive growth. But I'm sure there is more we can do. In these challenging times, defining effective and coherent strategies to reduce inequality is crucial. And to do that, we need to listen to each other and work together. I very much look forward to hearing the outcomes of this conference, the discussions you'll have in the course of the next 2 days, and getting your suggestions on how best the IMF can support our member countries in better tackling inequality. So thank you very much and all the best for the discussions ahead. Back over to you, Sequinder.
Thank you very much. Thank you very much, Deputy Managing Director, for those for setting the key issues out, and we'll be discussing all those things in the next 2 days. And thank you very much for inspiring the discussion and for joining us. Okay. I think it's over to you, Rodrigo, no?
Yes, thank you very much, Director Singh, and thank you also to Deputy Manager Director Sayeh for her welcome and setting the floor for the discussion that's coming. Well, I think we have a great panel today in which we are going to have 4 presenters. Each of them will have 15 minutes to talk, and later we'll have 30 minutes for question and answers. I think that this is a very timely webinar we're having now. At least we at the front, as Deputy Manager Directors said, we're trying to make our best efforts in trying to make efforts to decrease inequality. And as a matter of fact, we have been working on a lot of issues related to inequality and inclusion. So as a matter of fact, we're having some increasing number of IMF flagships, also SDN reports, and so on. We have a book titled How to Achieve Inclusive Growth that was published in December 2021. And also, I think, and we're very proud of this, we followed the completion of a pilot of 45 country studies that allow us to want to publish a note to guide the coverage of inequality issues in surveillance and program work. In addition, we're trying to support capacity development on inequality also around the globe. So in that sense, and given that we're facing now today, after the pandemic, and also due to the food prices increases, also a lot of issues on this problem, we think that this is very timely. So we think we're going to start now with Professor Ferreira, who is going to be talking about global trends in terms of inequality. Of course, this is a point that's really interesting after what is happening with pandemic and also what happened with the food chock prices. Professor Ferreira, as you can see on the screen, is the Amartya Sen Professor of Inequality Studies at LSE. He's a leading academic on this topic. He is also affiliated with the Stone Center at the City University of New York. But also he has a lot of work within our institutions. So because he has a long career at the World Bank, where he has position including the chief economist for the Africa region and senior advisor in the research department. So, well, very welcome, Professor Ferreira, and the floor is yours.
Thank you very much. I hope you can hear me well, and if not, please let me know. Thanks very much to the IMF for the invitation. Let me share my screen here. So I hope you can see that, and that if you can't see it, somebody will mention it. Yes, I was asked to provide a brief overview, an introduction to sort of what we know about COVID-19 and inequality. And I'm going to have nothing to say really about the war in Ukraine and the food price and energy price crisis afterwards. So I hope that'll be covered elsewhere. But I will try to tell you a little bit about what research has found about COVID-19 and inequality. And let me start by reminding us all of the obvious, which is that the pandemic was first and foremost a massive negative shock on global health and mortality. The Johns Hopkins coronavirus tracker now says that there were over 6.5 million deaths attributed directly to COVID, which is probably an underestimate of excess deaths over this period. And in this graph here, we see a subset of those deaths, which were about to the end of 2020. What you see here is not actually the number of deaths, but the number of life years lost per 100,000 people in a logarithmic scale. So it goes up to 1,000 per 100,000, which is obviously a very high number. And these are calculated in a paper that I have joint with Benoit Dessert, Olivier Sterck, and Daniel Mahler. We actually used life expectancy at each age in each country and the age-specific incidence of COVID to calculate how many years of life, expected years of life, were lost in each country. And in addition to the fact that they are very high in many cases, the other thing you see from this graph is that, contrary to what people expected in the beginning of the pandemic, mortality was actually much greater in richer countries and middle-income countries. This would be Latin America over here and parts of the OECD. Most of Africa is down here. And as I say, this is a logarithmic scale. So really, this is a 100-fold difference in terms of life years lost. The fundamental reason for this is that COVID mortality is strongly selective on age, right? Older people died of COVID much more. And there were simply many more older people in richer and middle-income countries. There are other factors like the rate of urbanization and the amount of time spent indoors versus outdoors. But that's the first thing to know, a huge mortality shock. And one, there may be issues of reporting. Here you see Tanzania and Burundi, where people were not fully believing these numbers. But in any case, the distribution of deaths was skewed in this way. The second thing is that obviously COVID was an equally massive negative economic shock. So here we have a picture from a paper by Angus Deaton in the same issue of the LSE Public Policy Review as the paper I've shown you before, showing the predicted, as best predicted by the IMF October 2020 WIO, the sort of predicted recession in change in per capita income from 2019 to 2020. These are very large numbers with an average of around 6 or 7%. And again, contrary to what many people expected, the recession was deeper in richer countries because it was deeper where there were more deaths. So larger deaths led to deeper recessions, though there were recessions that were very pronounced in poorer countries too. An important caveat here is that this is 2020, and the picture looks quite different in 2021. And it would be interesting to hear maybe Gabriela or somebody else will be able to tell us about what happened after 2020. Now, Deaton goes on in his paper to say, well, what does this imply for the distribution of income, for inequality between countries? And in this figure, he shows two things. The trend in inequality between countries unweighted by population, that is to say, just between GDP per capita in each country. And because, this was downward sloping, it didn't necessarily need to imply, but it did in fact mean that there continued to be a reduction in inequality between countries during 2020 at least, not necessarily later, but during 2020. The reason there are two lines here is that one uses one PPP exchange rate, the other uses another PPP exchange rate. That's a little confusing, but the main thing is that this is downward sloping. Interestingly, though, when we look at population weighted, that is to say, when obviously you don't treat treat each country equally, but you say China is worth, what its population is relative to Luxembourg, then actually we see a reversal in the declining trend. So the pre-pandemic forecast would have been this, and this is what you do when you incorporate this big recession. Okay, and the reason for this increase in between country inequality weighted by income is primarily India, which had a very, very large recession during 2020. China did much better, but China is now too close to the mean income in the world to reverse that fact. So we do have an increase in inequality between countries when they are weighted by population. Now, in this graph, there is nothing about inequality within countries. Everything here is between countries, and inequality within countries is basically being ignored. So what do we think happened to inequality within countries, and what can the data tell us? Now, most of us, expected that there would be increases in income inequality within countries, and for a set of reasons. And let me mention just a few briefly. First, we know that infection and death rates were themselves unequally distributed, with poorer people who often work in the informal sector and in closer contact with other people in occupations that require presence at a workplace, were more exposed to it. In many countries, including in my own region in Latin America, these people also live in dense urban slums without the health and sanitation they would need. So, the infection and death rates has been amply documented to have varied across space, across income categories, and across races, for example. That also links to labor market effects. And the main one I want to highlight in terms of the labor market here is that the ability to keep your job, and I'm really talking about 2020, okay, so I have very little to say about 2021 or 2022. But in 2020, the ability to keep your job was very closely related to the ability to do your job remotely. And this is strongly correlated with education and therefore with pre-pandemic incomes. That is to say, higher earning people before the pandemic were typically better able to continue to work and earn income during the pandemic. And I'll show you some evidence of that in a moment. In addition, let me say that the effects were also unequal across genders, as Ms. Sayeh mentioned, and in many countries also across races. In the case of genders, there are two main drivers that people have identified for the differences. One is that women, particularly in richer and middle-income countries, so I'm not sure about Africa, tend to work in occupations that are more oriented to the service sector, and therefore occupations that were harder to work remotely from. So gender differences in occupations, say, for example, the hospitality sector, hotels and restaurants and so on, was part of the reason there were differences in gender. A separate reason is that with schools closing around the world and the traditional gender roles in childcare, many women, even if they could do a little bit of work, simply had to be home to take care of the children, and that further contributed to this. So people speak of a she-cession for the recession in the United States at this period, which is unlike the usual pattern where men lose more jobs in recessions in the US. There were also some capital market effects. There were large injections of liquidity by central banks, and these led, the idea was to protect employment. And the jury is still out on whether it did or did not protect employment, but it did certainly lead to asset price inflation in the stock markets and elsewhere. And these, of course, benefited those who had assets. Yeah? Now, a big question to which I'll turn in a moment is, okay, these were the kind of market effects on labor markets and capital markets, but there were policy responses. Governments could react. And could these responses help mitigate these labor market effects? Could job protection schemes, such as the furlough schemes in the UK, the job protection schemes in Germany, employments and extensions of the unemployment insurance in the United States, the economic impact payments in the United States, those stimulus checks people got, or in Brazil, the auxílio emergencial, or in many countries in Latin America, there were also such responses, as I believe you'll hear tomorrow. Could they mitigate those effects? So that was a question. So these were our priors. What evidence have we got so far? At least again about 2020. And for this, I'm going to go more or less in the order of this slide. So I'm going to start with labor market effects. I'm drawing quite a lot on a nice review paper by Stephanie Stancheva of Harvard, which look at inequalities in the times of pandemics. It's a survey paper, so she herself draws on the work of others. This here is Raj Chetty's work. And what it shows is that the declines in employment were indeed negatively correlated with pre-pandemic wages. So this is the bottom wage quartile. These are changes in jobs relative to January 2020. Bottom quartile, second from the bottom, second from the top, top quartile. So even at the peak, which was in April in the United States in terms of loss of jobs, there were losses everywhere, but they were much less pronounced for richer people because, as I said, of the differential ability to work remotely and to keep your job in large part. And the recovery, which was almost complete by September for the top quartile of the distribution, was much lower for the bottom and very incomplete. So that's jobs. What about wages? Well, here's another picture. The original data here is from Eurostat. So this is the EU 27 in a large number of European countries. And in the yellow shades, you've got a lower income group, a medium income group, which is the medium, the middle four deciles, and a higher income group, which is the third decile from the bottom, so it's from the top. So you've got lower income, middle income, higher income. And you see almost everywhere, certainly on average in the EU, you see that first, there were big declines in employment income. This is employment income alone, and it's between the second quarter of 2019 and the second quarter of 2020. And this, I'm looking only at before government compensation here. I don't have the picture on after, which I'll come to in a moment. So big declines, on average, almost 8% declines for the poorest people, but much less, maybe 4% for the rich. So there are declines everywhere, but wages were more protected amongst higher earners. So this is in line with what we were predicting here in terms of the labor market effects, okay? Now, when we come to the policy responses, the first thing to know is that governments did transfer a lot of income to households. So this again is from the Stancheva paper, but the original data is from the OECD. It's for the G7 countries, all of them except Japan, and you also have the average for G7 and the OECD. This follows GDP statistics from the OECD from 2007 to the third quarter in 2020. So these last points here are the second and third quarter in 2020. Red is GDP, blue is household income. Both of them normalized to 100 in the first quarter of 2007. So what you see is that as the pandemic hits, there's a huge drop in GDP, which we already knew from here. This is consistent with this recession that we saw here. But household incomes did not fall in the same way. Household incomes in many countries, perhaps not in Italy, less so in Germany and France, but in Canada, in the UK, in the US, in the G7 on average, actually had big increases. So this is transfers, massive transfers here that are happening, which is a kind of a borrowing from the future. And I think not unrelated to the inflationary episode that we observe after this. You could think of this as income for household demand, and this is the supply of goods, right? So what did that do? Well, that meant this is changes in the Gini coefficient from a number of different studies for various different countries. And the main point I want to make here is that whereas when the policy response is excluded, so you're looking at inequality in market incomes, then indeed the inequality in market incomes rose, as we expected from the fact that poorer people lost their jobs more and lost more income. But when the policy response is taken into account in these richer countries, see EU 27, Spain, Italy, a bunch of European countries, Australia, Ireland, EU 29, then there was a decline, sometimes a large decline in inequality. So the policy response more than offset in these countries the effect of the pandemic on inequality in 2020. okay? And although this appears to have been more frequent in rich countries, it's not exclusive. This is just a picture of the Gini coefficient series from household surveys and household per capita income for Latin America. And what I want you to focus on is the pandemic here, 2019 to 2020. And here we see two things. One, the unweighted average doesn't rise or fall really, meaning to say that if inequality rose in a number of countries, it probably fell in some. The big decline in weighted inequality is Brazil. And I know it's driven by Brazil. Okay, it's driven by Brazil, who has the highest population in these countries. And this was driven by the auxílio emergencial and other increases in social transfers in Brazil, which again, like in these countries that we saw before, actually meant that although market income inequality was rising in Brazil, it was falling after the policy response. This was not true everywhere. It was not true in Mexico and Colombia. And I think as countries become poorer, it was less and less true. So I don't know what happened in Africa, and I hope that Professor Ozai and Mr. Kamalingin and other speakers later will help shed light on that. So let me conclude. This is my last slide here. I have 5 just simple points that I think we can conclude from the data, and then some questions. So first of all, the pandemic caused massive recessions and increases in poverty, as Ms. Sayeh also mentioned, in 2020, temporarily reversing a long time declining trend in poverty reduction in the world. In terms of inequality between countries, actually contrary to what people expected, simple inequality between countries, unweighted, continued to decline in 2020. But when you take into account population, then largely because of India, weighted inequality between countries did seem to increase. Within countries, the pandemic did tend to exacerbate inequalities in employment and wage incomes, both overall and between genders, and in some cases between races. But surprisingly to many, and to me, in many rich and some middle-income countries, the policy response in terms of social transfers and employment protection was so large that inequality in disposable incomes fell. Now, very importantly, this is all 2020. I don't know what happened in 2021. I'm hoping Gabriela will tell us something about that later, but this was the results for 2020. Questions going forward, with which I'll end. As I was just saying, what happened to this distribution of market and disposable incomes in 2021 and 2022? As two things happened, the world rebounded and rebounded unequally, with the richer part of the world, which had suffered a bigger recession, actually rebounding faster than poorer countries. But at the same time, a lot of these protections and a lot of these social transfers were withdrawn or gradually tapered. So what happened to what the picture I've shown you then? How did these dynamics play out in Africa? I don't have the data, and I'd be really interested to hear my fellow speakers on the panel. And finally, something that the Deputy Managing Director of the IMF did mention as well, the impact of school closures on learning is now known to have been very large and unequal. What it means for the long-term effects for these children in terms of their labor market performance in the future remains to be seen and could be very substantial. And so I actually think this point 8 is a very big question for us to keep looking at. So with that, thank you very much. And I'll stop sharing here. Thank you.
Thank you very much. It's a great presentation, and it's a good and very relevant starting point for the next discussion. Just to let know to everyone that's watching us that the presentation will be available after the webinar on the website. So you can take a look there if you want to look at any slide. So now we're going to be listening to Professor Darko Osei. He's an associate professor in the Institute of Statistical, Social, and Economic Research at the University of Ghana. He's also the Vice Dean for the School of Graduate Studies at the same university. His expertise lays in evaluate poverty and rural research. Also, he's doing macro and micro implication of fiscal policy, and he's looking to aid effectiveness and or economic development policy concerns. So, well, Professor Osei will be looking much more to the experience of Africa and also about policy that may have been used during the pandemic and after that. So the floor is yours, Professor Osei. Thank you.
Hi, is it morning or afternoon, depending on where you are? Thank you very much, Rodrigo, for the introduction. So should I share my slides or? I think I can, if it's okay. Sorry.
Now we're able to see the slides. Probably you might maximize the slides. That will be better.
Oh, okay. So let me do that. Yeah. Is it better?
Yes, much better. Thank you.
Okay. All right. Thank you very much. And so I think Chico ended with some very important questions that needs reflection. I probably don't have answers for those questions, but certainly based on some of the work that we have done and are doing, we are able to reflect a bit on how the pandemic has actually impacted on inequality and the derivatives thereof. So, of course, if you think about the inequality trends generally or globally, it is important to note that the decline in inequality, if you look at the relative inequality, is driven largely by declining inequality between countries. Okay, that's from the global picture. Indeed, if you look at the global picture within sub-Saharan Africa, i.e. the aggregate picture for sub-Saharan Africa, one observes a different sort of trend in the sense that one sees that inequality has actually increased over the years. And just like with the global trends, it varies from one country, of course, to the other. And one then will begin to ask some of the questions that, again, was alluded to in the first presentation as to why some of the countries within sub-Saharan Africa are seeing different trends, in particular increasing trends, whilst others tend to have observed or recorded declining trends in inequality. Okay. Of course, if you take these examples that I have shown on the slide, you take countries such as Ghana, Mali, Ghana, Tanzania, Zambia. From the 2000s, one observed that inequality has actually increased. And of course, other countries such as Kenya, Malawi, you observe that the trends have actually declined. Now, if you relate that to some of the factors which help explain how or whether inequality can be exacerbated, particularly in the face of some of the shocks that we've observed over the last few years, then you begin to ask yourself the question of whether indeed policies were geared towards the kinds of factors which we know will tend to drive inequality one way or the other, and particularly for some of these countries. Now, I will sort of rely on some of the work that the Center of Excellence for Inequality Research in Africa have been doing in a number of countries, trying to understand inequality in a bit more depth, particularly for Ghana, Kenya, and South Africa at the moment. We're currently doing some more work on Mali and Mozambique, but I'm not going to share the results of those countries in this presentation. Now, if you take Ghana, South Africa, and Kenya, what is interesting is the different dimensions and indeed how the inequality plays out in these three different countries. So you take Ghana, for instance, and you observe that if you do the plots of the inequality across regions in the country, you observe that the northern regions, i.e. Upper West, Upper East, and Northern, which are on the top of this diagram, show the highest inequality. And it's indeed consistent from about mid-2000s to the latest version of the data, which is in 2016 and 17. Now, incidentally, these regions are also the regions that exhibit some of the highest incidence of poverty. Okay, so again, of course, one would typically have expected to see inequality being highest in the regions that have a relatively higher per capita income or expenditure in the country. Now, if you contrast the result for Ghana with that of, say, Southern Africa, and indeed for Kenya, what you do observe is that if you do the inequality by deciles, income expenditure deciles, you do observe that the highest deciles typically will have the highest inequality relative to the lower deciles, which again contrasts with what we do find for Ghana, and which I'm saying is a bit strange in terms of what it's showing. Now for Kenya as well, again, the result is typically consistent with the results that we do find for the South Africa, where for those in the higher income brackets, the inequality in that cohort tends to be much higher. But of course, there are other dimensions of inequality for these three countries. So in South Africa, inequality plays out in terms of race. And so you find that inequality tends to be higher, or the between race inequality tends to be quite high relative to the within race inequality. And so generally, I mean, for South Africa, what you tend to find is that the between inequality explanation of total inequality will tend to be relatively quite high. Also for South Africa, I think employment does play quite a key role in explaining inequality. And of course, generally, the between inequality tends to be very high in South Africa. Now, if you relate that to Kenya, again, it's largely similar, although in terms of inequality across groups tends to be generally high, but much lower than that of South Africa. But for Kenya as well, and as I alluded to from the earlier slides, expenditures for the inequality among higher earning cohorts tends to be much higher relative to the non-poor, relative to the poor, sorry. Okay, and of course that plays out also in urban areas than in the country side or in the rural areas. And in large parts in Kenya, inequality plays out quite significantly in terms of the access to land. And so there is increasing inequality in access to land over the years. And you do observe that gender of the head of the household is also quite important in explaining inequality, which females actually, or within the female cohort, inequality tends to be much higher. For Ghana, the results is very strange in the sense that, again, as I mentioned, the relatively poorer part of the country tends to have very high inequality, and inequality between groups does not seem to be too important. So generally within each group and within each region, you tend to find that inequality within the groups tend to be quite high. Okay. Of course, the poor in the urban localities seem to have actually benefited more from increased growth compared to the poor in the rural localities. One of the things which is also cut across the three countries is the fact that generally there seem to be increase in the improvements, or there seem to be improvements in access to social and infrastructural services for all households, but particularly for households in the higher income quintiles. Asset inequality has decreased for Ghana, but again for South Africa and for Kenya, asset inequality seems to have actually increased. Now, in the studies that I actually based this presentation on, they looked at the existing policy responses generally of inequality over time. And again, you do find some similarities, but obviously there are differences. Similarities in terms of the emphasis on economic growth and stability, fiscal stability, and largely it's observed for all the three countries. There seemed to have been a bit more of a change in the structure for South Africa. In the case of Ghana, in some other study, myself and some other colleagues did, we talk about an adverse Kuznets tension for Ghana, because what you do observe is rising inequality in the presence of limited transformation. One of the key things which you do observe, particularly for Ghana, but also I think it's fair to say for Kenya and then South Africa, is increasing social protection programs. Okay, and they manifest themselves in different forms. In the case of Ghana, you have the health insurance, you have the cash transfers, and of course, from about 2017, 2018, in the case of Ghana, there is this free senior high schools. And of course, they have their own implications, fiscal implications, and what that also means ultimately for the poverty and inequality agenda. But be it as it may, it's still seemed to have been a policy measure that may have actually impacted to some extent on inequality in a positive way on inequality. So what are some of the suggestions that one can make based on some of the observations that we make from the different diagnostic studies that we look at? I think that what is clear is that increasing social and infrastructural amenities tend to have a positive correlation with reducing inequality. And generally, one observes some degree of improvement along those lines. There are regional disparities, particularly in terms of access to social and economic infrastructure, and that in large part could also be playing out in terms of some of the inequality differences that we observe across within the countries, but across different regions. But I think that in large part, another study that myself and some colleagues were involved in, looking at the dynamics of inequality or trying to explain the dynamics of inequality and poverty over time, what we do find is essentially that if one were to actually try and then cure this dual problem of both poverty reduction, but also reduction in inequality, then factors which do matter are essentially higher education, employment policies, such as being pursued in South Africa and in Kenya. Of course, there is some element of that also happening in Ghana, but it has its own dimensions. But I think also importantly, the social safety nets policies that these countries are pursuing. Thank you very much. I'll end here and then we'll wait for question time to elaborate a bit more. Thank you.
Thank you, Robert. And thank you for the presentation and for the introduction to the case of Africa. And well, following that, with that idea, now we're going to turn the floor to Mr. Peter Kamalingin. He is the Pan-Africa Director of the Oxfam International. He has over 20 years of experience in the areas of social justice, development policy analysis, humanitarian planning, and conflict management. So, Peter, you're welcome, and please, the floor is yours. Peter, I think we're not able to listen to you. No, not yet.
Peter, because you have your headset, because I think you have your headset plugged in, you might have to select the microphone input on Zoom. Do you see where the microphone is at the bottom? There's a little arrow. If you click on it, it allows you to select the microphone input. We can hear you now. We can hear you now.
Okay.
Thank you.
So that's fine. Sorry about that. Yeah. So I think, sorry about that. I always speak obviously, but yeah, that's fine. So thank you very much. And let me also, thank the colleagues who have spoken already, Francesco and Professor, and I think also the framing that Antoinette shared. Let me, first of all, start by, appreciating, I think, speaking also from Oxfam, and to say that, the thing that I'm going to share, I don't have a PowerPoint, but I'll speak more in prose because I think we're coming after the gentleman who shared. But I should be able to share, the talking points for reference by the Secretariat. The insights I will share are largely from what we normally do as Oxfam, we do, annual commitment to reducing inequality index reports, and we test basically, government decisions on social spending, on taxation, and labor rights. We test countries, 106 countries throughout the world on that, and we do this analysis both globally but also within regions and within countries. So I think that those are the insights I'll share. And I think that we will also share the link to the detailed report, particularly for Africa, because I think that would be relevant for this session. So let me start by noting that we at Oxfam remain very encouraged to see that the IMF continues to pay attention to this problem of inequality, this crisis of inequality, and also creating the spaces such as this one to, frame discussions on how we, together, of course, with African governments, with African people, with the bank, with the donor partners, and work together with all the allies to fight this problem of inequality. I only hope that this will eventually one day translate into bolder inequality reducing policies in IMF-supported programs, I think, in the continent. For now, I have to say that we still struggle a bit to see enough evidence of this. I was just speaking yesterday with some of the colleagues, some of our partners from Southern Africa, particularly in Zambia. They really appreciate that there's a lot of consultation that goes on, but I think that between the IMF and the donors and the governments, at least speaking from the perspective of civil society, the decisions are sometimes opaque. And there's a sense that either between governments and IMF, there are always preconceived ideas. So there's a sense between the commitment and seeing that translating into actual practice. So I think that I just thought I should share. I owe it to the partner that I spoke yesterday from Southern Africa to share that here. We all know, and I think that has been shared by different colleagues, that this continent, Africa, has been facing a crisis of extreme inequality. But this pandemic and the follow-on reverberations of the war in Ukraine have only supercharged it. So it's not something that is new. It was there, but I think it has been worsened. Just a few facts to point out the severity of inequality in the continent for purposes of just grounding our conversation. 7 of the 10 most unequal countries in the world are in this region. Inequality, of course, is undermining growth in every AU member state as far as we see. The top 1% of Africans hold 33% of Africa's wealth. So this inequality, such inequality, is a major cause of course, as Antoinette also says, could be a major cause of instability and insecurity, and actually makes nonsense of all these commitments we are making on SDGs. The continent was woefully unprepared to face a pandemic, because even before, 52% of its citizens lacked access to healthcare, 83% lacked access to social protection, and 52% of the workers had no rights to formal labor rights at all, no access to formal labor rights. The pandemic dramatically increased poverty and inequality. It resulted in over 30 million jobs and contributed to over 40 million Africans being driven into extreme poverty. 30 million people lost their jobs. This is the highest in a generation. Now, the 6 richest Africans own more wealth than the poorest 50% of the 50% of the people of the continent combined. And I think I should also say that, contrary to maybe even relatively different from other regions, the worst impact of COVID-19 in the continent, even on inequality, was not so much in the health impact, but actually resulting from the actions that government take, including restrictions, lack of movements. The impact on that, on food, distribution systems, on jobs was much higher. So the non-health impact were actually higher than actually the direct health impacts in many ways. Africa's debt burden has also risen sharply. Debt servicing is almost 3 times as much as education spending. It is 6 times the health spending, 22 times the social spending. And listen to this, 236 times more than the climate adaptation spending. This is important. I have to also say that, I'm just taking a kind of a social justice lens, because that also has implications on some of the policy choices that we take to address inequality. The governments across the continent, some more than others, of course, made courageous attempts to respond to the pandemic, but most lacked affordable finance which prevented them from sharply increasing spending. I think that we have also heard from colleagues, from Professor Francesco, that, where, in the rich countries, there was more investment in social spending, which actually reduced inequality rather than increasing. But for the majority of the countries in the continent, they didn't have much space to be able to do that, because the beginning point is that these are poor countries. In fact, low-income countries in the continent spent only 3.1% of their GDP on social protection, and emerging African economies spent 5.3% of GDP. This is compared with 19.1% of the OECD economies. So you can see the difference in investments in social protection. Much of this spending went towards healthcare and social protection, but most African governments have already phased out these measures. As we speak, many of them have already phased them out. This is leaving the continent vulnerable, of course, to the next shocks that we saw right from the beginning of 2022 this year, the food crisis that I think that has been referred to. The rapid withdrawal of these measures, of course, in some cases encouraged by the donors, including IMF, without a long-term significant increase in healthcare and social protection spending, is putting African countries in a worsening situation. Now, most countries are grappling with, of course, a historic rise of energy and food prices, as we all know. Unfortunately, instead of pursuing active and bold policies to secure financing for crucial and inequality-reducing social spending, such as taxing wealth, many governments in the region have been, forced to take austerity. And I think, as I said, that these are some of the, either unintended consequences of some of the austerity measures that are being encouraged by different, allies and partners, including the IMF. Now, on the level of the continent, for the 3 AU member states, will cut their spending by a cumulative 5.4% of their GDP by 2026. This will total to about $183 billion. Now, this is massive, of course, happening at a time when countries should do everything they can to increase spending, particularly on public services, on social protection, and most importantly, also on food production in agriculture. Africa is aiming to drastically slash and burn its way to repay crippling debt burden. This is exacerbating, of course, inequality on the way, making recovery even harder. I think this is something that we need to put in context. Unfortunately, of course, this is happening with tacit or even direct encouragement and sometimes pressure by the donors. While some countries are pursuing austerity by their own volition, most of the African countries have been advised by the fund, I think, to go down this path. And we know that in many of these contexts, advice from the fund and from a donor is not just advice, it's more than advice. So in fact, in an earlier report, we found out that during the first year of the pandemic, the IMF encouraged 33 African countries to pursue austerity policies. In the second year of the pandemic, the IMF required 10 African countries to pursue austerity measures through conditionalities in their agreed loan programs. Now, these range from freezing or even reducing public wage bills, removing subsidies, broadening or increasing VAT, which is a very progressive tax framework, which is further targeting of social protection measures, among others. Now, it is alarming to see that these policies pushed and implemented in the middle of an unprecedented cost of living crisis is weighing heavily on the poorest who are struggling to make ends meet. For instance, to fulfill the conditionalities under the IMF program, Kenya, where I'm speaking from, increased taxes on cooking gas and food. Now, this in a country where more than 3 million are facing acute hunger as the driest conditions in decades spreads a devastating drought across the country. Nearly half of all households in Kenya are having to borrow food or buy it on credit. Recent studies show that, in a country like Kenya, ordinary households spend anything between 50 to 60% of their income on food. Ironically, most of these households are actually food producers, they're potentially farmers, but because of a lack of access to inputs, to seeds, to finance, it becomes very difficult for them to produce at all. And of course, climate change is wreaking havoc. So just recently in Zambia, the IMF board approved Zambia's loan program. And here, let me say that, we appreciate and welcome all those efforts that the fund has exerted to support Zambia in the efforts to, restructure their debt with its creditors. Nevertheless, I think the IMF supported programs envisages a very massive and in some ways worrisome reduction in the public spending, aiming to turn a 6% of GDP deficit to 3% surplus in just 3 years, which is a very short time. Our colleagues at the fund have said that the program also aims to increase social spending, which I think is good. But this is welcome and encouraging. However, we need to understand that this massive spending cut is accompanied by a very small increase of social protection spending from 1.3% of GDP in 2021 to 1.6% of GDP in 2025. This is significantly small. This is meager compared to, of course, what the Zambian people need and aspire. Moreover, fuel subsidies are being cut drastically and extremely quickly. And there continues to be a heavy reliance on, of course, increasing VAT instead of levying taxes on the rich. This is an area that we really need to look at. So this severe austerity will only, I think, in many ways add fuel to fire. Looking ahead, though, it is important to stress that reducing inequality in Africa requires both national and international efforts. Next month, and I think this probably answers one of the questions that Francesco was asking, we will be releasing one of the first detailed analysis looking at what governments did or did not do during the critical first 2 years of the pandemic. And this will review again the things that I was speaking about: social spending, tax and labor policies, and of course the actions of 161 countries across the world. So this will give us a sense of which direction of travel governments in the continent are going and what they need to do to prioritize reduction. Let me just spend maybe a few more minutes just to speak a bit more about what needs to be done. And I have a message for African governments, I think, at the end. Governments need to immediately, of course, end austerity policies and invest massively in public services. That's an important area. I think that one important area to be looked at is, of course, investing in food productivity, because I think that's where most of the spending in families is going to, as I've said. This will be possible, of course, if countries can enact policies that mobilize domestic revenue in a progressive manner. Looking more at taxing wealth, taxing the windfall profits of corporates. Working together within the region and also with the international actors to for example, reduce IFFs, illicit financial flows, because we saw that, for instance, Oxfam found that if the governments of West Africa were to increase their tax revenue by 1% of GDP in the next 5 years, they could cancel a lot of their austerity measures and free some income that could, finance free education for 1 year. To implement such inequality reducing policies, of course, governments need support from the international community, as I've said. And the most powerful tools governments have is public spending. However, fiscal space has become very constrained and restrained in many of these countries. We need to have, of course, a comprehensive debt reduction to all African countries. That's an important area in itself. The other thing is that we really want to encourage the IMF and other partners to go a bit slow on recommending austerity measures in Africa and have some flexibility clauses in their loan programs to allow countries the breathing space to enact the needed inequality reducing policies. This means the fund has to be less rigid on deficit and inflation targets. I think that's an area that we really need to look at. At the very least, the fund should adopt a no-harm approach and avoid any measures and cuts on its programs that have social negative impacts. However, we would like the IMF to do more and have a positive impact on reducing inequality. Lastly, I think this is we also need to go back to the measures that helped Africa and the world during the pandemic. These include, of course, emergency conditional financing. We are happy to see that the IMF staff is proposing a food stock window for emergency financing. Hopefully, the board will also approve this in October. Another measure that was vital for African countries, of course, is the SDR issuance in 2021. I should say here that we are deeply, disappointed at the failure of rich countries to channel 20% of their SDR to developing countries. This must happen without further delay. However, this does not mean that a new issuance is not in order. Many countries spent a portion of all their SDRs on social spending, and we need a new issuance now to once again avoid disaster and reduce inequality. I cannot end this without emphasizing a message for African governments and policymakers, the political class. Whichever way we look at it, they have to take bold decisions, take political choices as sovereign governments. That may be painful, but which will genuinely and progressively increase productivity, increase jobs for young people, end corruption, tax wealth, and work collaboratively to encourage regional trade and stop, these illicit financial flows. But as they take these long-term decisions, they need support and understanding from the IMF and other partners, not more austerity. The richest avoid austerity, how much more the poor? I think I want to end there. Thank you very much.
Well, thank you, Peter. Thank you for your remarks. I think we are listening, and of course, it is very useful for our work. And now we're going to be turning to Gabriela Inchauste, who is going to be talking a little bit more about inequality in the case of sub-Saharan Africa. Gabriela is a lead economist in the Poverty and Equity Global Practice of the World Bank. She's currently also a global lead for the Equity Policy Lab, assisting poverty teams across the bank with distribution analysis of fiscal policy, climate change, and climate action. She also worked on Western Africa and previously on Latin America and Eastern Europe. She also is doing research on distribution and impact of fiscal policy. So I think this type of way to look at policy might be really interesting for what we're discussing now. Prior to joining the bank, she worked at the International Monetary Fund and the IDB. So thank you, Gabriela, for being here, and the floor is yours.
Thank you very much, Rodrigo, and thank you for the invitation to come and present. I'm sharing my screen. I hope you can see it. Okay, so going back to where we were talking about a little bit earlier, prior to COVID, many of you know, there had been quite a bit of progress in terms of reducing poverty and inequality across the world, and including in sub-Saharan Africa. As you can see in the top left chart, average extreme poverty fell in almost all regions, in all of the regions of the world, and inequality, regardless of which measure you use, also tended to decline, but less so in sub-Saharan Africa and in MENA. An interesting aside is that inequality had fallen more for commodity importers, even though on average initial inequality is much higher among commodity exporters. And of course, inequality trends varied across the sub-Saharan region, with some countries seeing large declines and some seeing increases, as Professor Sayeh had mentioned. The latest data that we have prior to COVID points out the fact that despite these efforts to, on average, reduce inequality, the levels of inequality in sub-Saharan Africa have been continue to be very high. In some countries, not just high by regional standards, they're high by world standards. Moreover, when we look at longer-term measures of inequality, such as looking at intergenerational mobility, we see that sub-Saharan Africa was among the lowest in the world. Here, this map shows the extent to which educational attainment of children was completely independent from the educational attainment of their parents for the 1980s. And what we see is that this measure of relative mobility points out that most of the sub-Saharan countries are in the lowest quintile of relative mobility in education for those born in 1980. Now, this hasn't improved in sub-Saharan Africa and most of the developing world since the 1960s, which puts the question about, what potential inequality traps as the rich continue to have rich children and the poor continue to have poor children, and there's no hope for mobility. And I think that this is really what can be at the root of discontent. And it's definitely one of the areas that one has to worry about when thinking about pre-fiscal inequality. And now COVID, as others have pointed out, reversed many of these hard-won gains. Here I'm showing our projections for the headcount poverty rate published in April. We're going to have new projections going to be published in a couple of weeks, but I don't think the story is going to change very much. Basically, the estimated decline in poverty prior to COVID, that projection was actually superseded by an increase in poverty headcount rate in 2020 and into 2021, which not only led to an increase in the headcount rate, but more importantly, it led to an increase in the number of poor. Now, notice that on the right-hand side, that because of demographic projections, even before the pandemic, the projection was that the number of people in poverty was going to increase simply because the consumption growth of the bottom of the distribution isn't fast enough to overcome the growth in population. So really, the pandemic has severely increased the number of people in poverty, despite some signs of recovery in 2021 and 2022. Moreover, the education losses have been enormous. This graph comes from our very recent publication on learning poverty, which measures the share of children who are unable to read and understand a simple passage by age 10. Already prior to the pandemic, this share was very high in sub-Saharan Africa and has gotten worse according to our simulations for 2022. Now, notice it wasn't the worst increase relative to, for instance, Latin America and other regions of the world, but nearly 90% of children not being able to understand a simple passage is a very worrisome concern for this for the inequality in endowments. On the right here, I show that the gap in primary school completion between average and the bottom 40% of the distribution was also among the highest in the world for both East and West Africa. So all of these point to some of the areas that Professor Ferreira was mentioning, that the pandemic has certainly aggravated existing levels of inequality that were already of worry before the pandemic. I think the most important area where we're now really watching is what's happening to food. No, so food systems during the pandemic were quite actually impacted. The border closures, checkpoints, lockdowns had an impressive impact on transport costs and food availability. Seasonal price increases were exacerbated due to panic buying at the beginning of the pandemic. Also, dampened demand for perishable foods caused substantial losses for producers. And small and medium-sized agro-processing firms were really adversely affected by lower sales, both domestic and international, as well as difficulties in accessing raw materials and needed inputs. That, of course, led to reductions in capacity, employment, and output that are going to be difficult to overcome. Our household survey monitoring the impacts of the pandemic throughout different countries in the world, actually all over the world. We had parallel surveys going, and what we found is that food security definitely became an issue across regions, but most severely in sub-Saharan Africa, with 44% of respondents saying that they had to skip a meal in the last 30 days. So food insecurity increased. And as mentioned before, there was a huge effort to try and expand social protection systems in the region, and as in other places around the world. No, so there had already been quite a bit of an effort to expand in social assistance systems around the region. We observed 28 countries expanding or creating new systems during the pandemic. And while in many cases their pre-existing systems really helped to increase coverage and were the basis for this scale up, in some cases we saw some really interesting innovations in terms of setting up brand new systems. So in Togo, the authorities tapped the voter registry, and an ad hoc payment platform was created during the pandemic. In Kinshasa, we saw a registry that was built in real time based on anonymized data from private mobile companies. So there was this big push to increase social assistance. But despite this big push, relative to other countries, a very small share of the populations received any kind of government assistance during the pandemic. This again kept coming from our COVID-19 household or high frequency data that was undertaken across countries and throughout the world. Now the recent recent increases in food prices are putting the vulnerable at risk. As the managing director mentioned, food prices in many regions are increasing faster than regular total prices. And what we are especially worried about is that the poor tend to dedicate a larger share of their budgets on food. So this has aggravated already high levels of food insecurity in the region. Here I have the Famine Early Warning System Network, a map built from their data. And they're seeing crisis and emergency situations in the Horn of Africa, very stretched situation in the Sahel and parts of Congo, Mozambique, Madagascar, and Zimbabwe. This is their expectations for July through September of this year, and their forecast for October to January is looking not much better. Particularly in the Horn of Africa, where there are many regions that are in emergency situation. Now, obviously, this food insecurity situation is not just the result of the recent increases in world food prices. It is also being driven by climate change and the impacts of very large weather events, both floods, droughts in the region, and other weather events, as well as insecurity. We know that all of these things are related, as higher levels of food stress can lead to conflict, and which in turn leads to high food stress as people are being driven out of their homes, particularly in the Sahel and some of the other regions. So what we've seen in terms of policy response in this past year has really been focused on subsidies. So this is data coming from the Tracking Global Social Protection Response to Price Shocks, April data for Ugo Gentilini and others at the World Bank have been tracking the response to COVID, as well as more recently the response to the food price crisis. What their numbers show is that over 90% of the policies enacted in 2022 have been focused on subsidies. If we zoom in, we see that most of that response has been focused on food and fuel subsidies. Over about 50% or a little over 50% has been focused on food and fuel subsidies in the region. So in terms of policies going forward, I think one has to go back to think about the things that need to be done in the immediate run, as well as the things that need to be done sort of long term, and to protect both pre-fiscal inequality as well as address post-fiscal inequality. So in the very short run, the subsidy measures that exist that have been put in place to keep fuels, electricity, or gas affordable in response to this crisis should be time-bound, transparent, and fully budgeted. Why do I say time-bound? Is because there is quite a bit of evidence that these subsidy measures are not the most efficient. Typically, they go to the top of the distribution largely go to the top of the distribution simply because the top of the distribution consumes more. So there are definitely much more redistributive measures that one can take that are also more affordable. In parallel, there's really need to continue to roll out adaptive social assistance systems that can replace these subsidy measures to provide immediate support in times of crisis that can be easily rolled out. And that will take quite a bit of effort because in many cases, they require social registries and other digital infrastructure to make sure that they go to the poor, the people that need them the most. Now, these social assistance and targeted cash transfer measures need to go hand in hand with much more work in terms of reforms that can improve food networks and build resilience. So here we're talking about policies that promote development of competitive food and agricultural value chains, policies that address bottlenecks in logistics and supply chains, and policies that, and the removal of policies that incentivize single or monoproduction and limit crop diversification, because we've seen that can really make a big dent in terms of food security across countries. These efforts, so if you think about it like a two-punch strategy, one punch is immediately address the risks that households are facing through social assistance, but at the same time try to build up strong agriculture and food networks so that those can be kind of more medium-term livelihood strategies for the poor. In addition, over the medium term, they need to be accompanied with climate-smart investments to develop more resilient and productive infrastructure. So things like irrigation, insurance, and improved inputs to, as well as addressing the challenging issue of land and property rights, need to go in parallel. In terms of the inequalities, pre-fiscal inequalities that I talked about, and learning in particular, really there's a need to implement programs for learning recovery and acceleration that can help students get back onto their pre-pandemic learning trajectories. And for this, there is a nice framework that thinks through what are the key things that need to happen for this learning recovery to take place. Obviously, this framework, which I invite you to take a look at, needs to be customized to each country's situation, particularly in the fragile and conflict states. But in all cases, there is definitely a need to reach every child, keep them in school, assess their learning levels regularly, prioritize teaching and the fundamentals, increase the efficiency of instruction, and develop a psychosocial health and well-being. Finally, I'm going to mention redistributive fiscal policies as potential for addressing some of the inequalities. But I think when one thinks of redistributive fiscal policies, one needs to think of the whole package. It needs to be the combination of progressive tax policy as well as well-targeted spending that is really going to make a difference in both the endowments of people, reduce inequalities in their endowments, as well as help them navigate the work life and allow them to have the basics in terms of social protection and basic needs there. So let me end with that. Thank you very much.
Thank you, Gabriela. Great. So it's a great closing for our presentations. So maybe I can start from here and maybe ask Professor Ferreira. So jumping from Gabriela's presentation, Professor, how do you think we could try to tackle down the impact of education and what happened during the pandemic in terms of public policy for the future? this is also the last topic you put on your presentation. I mean, education should be something that we should matter for the future. So how do you see, or what could be policy different governments should follow in that sense to tackle down the lag on education we have right now?
Thank you, Rodrigo. I mean, I think, Gabriela had a nice framework there at the end, this rapid framework, which I think makes a lot of sense. I would just mention two things about this educational loss, the learning loss that took place during the pandemic in many, many places. And some of, actually, I think the best research on this comes at the moment from the World Bank, from Gabriela and colleagues, Norbert Schadi's group, and so on. It wasn't just that people didn't learn as fast. In many cases, there was actually forgetting. So if you do tests, this learning, this cognitive skill tests and standardized tests of various sorts on children of different ages, in Africa and elsewhere, people sort of lost, they went backward, kids went down, which is, of course, is what you expect. It happens every summer a little bit, except here it happened, over the course of a year or more in some cases. Regaining that, recovering that is not going to be trivial. And ideally, you would need to do two things, I think. One is, we know from all kinds of different studies of different educational interventions, I think I can say we know now that the most important input into kids' schooling is the quality of their teacher. And the quality of their teacher measured largely by their pedagogical methods, not so much by whether they're tenured or not, or how much experience they have after the first 3 years. So there's a lot of work that's been done on this. And so getting good teachers is super important. The other thing we know is that when people lag behind, they probably need some extra help, sort of programs beyond just the school day, some additional hours, perhaps, some amount of tutoring for the kids that fall behind and so on. Now, when I say this, right, even though I don't see any of your faces on the screen except Gabriela's, I can see you rolling your eyes and thinking, that costs a lot of money. How are we going to do that in Africa where there are real challenges? And what I want to say is it is a real challenge. I don't think it's going to be easy at all. I think, Gabi's framework, the World Bank's framework is very nice. I think policymakers need to realize it's going to be a real challenge to recover what these kids lost during this year. It's going to take investment, and investment should be very well targeted on teachers and on the quality of the teaching. It's not just raising wages. It's the nature of the pedagogy, the nature of how children interact in the classroom, which is a hard thing, but it's the most important thing. And, it's going to take resources, everything else that Peter said about allocation of resources and the speed of the fiscal adjustment should bear this in mind as well. It's going to take some resources, and very well spent resources, for these children to do better. That's my sense, at least.
Thank you, Francisco. Then a question for Gabriela and also for Professor Sayeh. Both stress the relevance of cash transfers during their presentation, during the pandemic and so on, and probably cash transfers may be also relevant now when we have increases in food prices and also on fuel. So probably the question there is, okay, how do we implement this? As Gabriela showed, probably we don't have so much coverage in Africa as we wanted of this type of cash transfer. So in some way, from the perspective of Professor Sayeh, how can we do it in Africa? And probably from the perspective of Gabriela, that has been looking all around the globe, what have we learned from other countries around the world to increase that coverage of cash transfer in the future? So probably if we might start with Professor Sayeh and then Gabriela, please.
Thank you very much. And certainly a lot of very interesting points that have been raised in all the presentations. There is a lot to chew on. Yes, this issue about cash transfer is always a thorny one, particularly like Francisco was alluding to, in Africa, where fiscal space is in some countries almost zero. Okay, so of course, I think there are two important issues here relating to the cash transfer discussion. One, creating the fiscal space. Two, making the cash transfer in itself more efficacious so that you can effectively, over the medium term, properly have sustained improvements in the livelihoods of these households who benefit from the cash transfer. Of course, the second part, I think there is increasingly evidence which suggests that we probably know how to do that by essentially thinking of supporting relatively poor households or vulnerable households within the livelihoods framework. And of course, I know that when this issue has come up, typically, and when we've had discussions with policymakers, typically the first issue that comes up is, no, it's too expensive. But if you think about it, we do have MDAs, or ministries and other agencies of government that are doing the other elements of the livelihoods approach. And so the issue borders more on coordinating the social assistance framework in a way that will then complement whatever cash transfers are done to these extremely poor households. I think it is important that we increasingly emphasize that and then take advantage of the different agencies that work in the sort of government agencies. Because of course you are doing non-formal education. Of course you have a lot of other government programs that are doing assets transfers. Of course you have a lot of other government agencies that are doing training. You have health elements as well that one could take advantage of. On the ground, however, what you do find is that there isn't significant coordination among these different elements, which then will feed into ultimately improvements in the livelihoods of these poor households in a way that can be sustained. On the first element, which is creating fiscal space, I think that sometimes when I have engaged in discussions around fiscal space, I keep saying it becomes a bit boring. It becomes boring because somehow we only see fiscal space in terms of taxes. But I think that we also must be aware that, of course, there is a limit to which you can tax. And of course, that could invariably have implications for economic growth, which will then come and then bite you back in terms of affecting inequality and poverty. So my own take is that we need to look at our spending efficiency. And I think right across Africa, I think one could invariably, if we are serious about it, find ways by which we can improve spending efficiency. I mean, you can give all sorts of examples. It's very common to go from one African country to the other where you see all sorts of government vehicles running around during weekends doing XYZ, which will probably not be related to anything relating to the work that you're supposed to do as an agency. Again, once you bring these issues up, people then will dismiss it and say, oh, it's not that huge an element of the expenditure. But it is these little drops and some of these expenditures and the amount that is required to actually do the cash transfers, or the marginal amount that is required to do the cash transfers, is not that great either if you take individual households. So I think that we should increasingly look at expenditure efficiency of spending, where we can claw back some fiscal space to undertake these cash transfers. Thank you.
Yeah, so from my point of view, the discussion on social safety nets, I think the lessons that we learned from the social protection pandemic response in Africa, I can highlight 3 insights. First, the fact that it's very important that the delivery systems and complementary interventions have complementary interventions, especially when looking at social registry and good data. So these complementary interventions really are what build up can build up the social protection system. And there's been, quite a bit of investment in building these up. And to the extent that they are built up, having adaptive social protection response is going to be feasible, not just in the short run, but over a longer period, anytime a crisis hits. We've also had the good fortune of looking or witnessing groundbreaking innovation that was enabled by data and technology that previously perhaps was not possible. So I think that there is definitely room to expand the social protection networks, and there's some really good examples. I think tomorrow you will hear more details of some of these, but definitely more room or something that helped very much during the pandemic. And then third is that it really is important to manage the fiscal space for social protection. That I completely agree with Professor Sayeh. There is definitely room to increase fiscal space on the spending side. Are we really spending every dollar that we have, or every pound that we have in the most efficient and effective way? Is it really going to the bottom of the distribution? I think these are questions that we need to pose, and what matters is the totality of the fiscal intervention. Yes, it's important to have a progressive tax system. Nobody is denying any of that, but that doesn't help if then that goes to fund expenditures that are mostly going to the top of the distribution, right? That has the complete opposite effect on inequality, which in the end is our end goal. So taking that into account, it's very important to look at the combination of tax and transfer policies and look at what it means to open up fiscal space. And in terms of directions, some of the emerging directions for strengthening social protection in Africa that have come out in a recent report that the bank had are to diversify the policy objectives and instruments for expanded coverage and reach of social protection, particularly focus on informal sector workers and urban areas who were very hard hit during the pandemic. They are not often the people who we think are the poorest of the poor. I mean, normally when we think of the poor in Africa, we think rural areas, but it was actually for many urban workers, very strong and very clear that they were outside of some of the safety nets that needed to be in place. It's important to strengthen, as I said, the adaptive delivery systems and leverage data and technological innovation for wider coverage and for wider reach. And it's important to enhance the financing for more sustainable coverage. Where do we find that financing beyond donors? In order to make it sustainable, it needs to be domestically funded. So I think it is a big challenge for all of us. And my big pitch is to try and ensure that these decisions are evidence-based, They should not be based on, oh, I think this is what the effect will be, but to try and go to the data and to analyze the combination of tax and transfer policies, tax and spending policies, and what they're doing to inequality. Thank you.
Thank you, Gabriela. And Peter, we have some, we have some questions from the audience. And so one of those, well, it says, currently resources are quite scarce and public authority are divided between development policies and social measures given the current social context. Could you please make us proposal for an adequate redistribution policy in this context? So do you see space for a redistribution policy at this moment at all, if any? And so, and also from my point of view, so usually we're thinking about increasing social transfer, which might be relevant in the current situation for some households, but also we're talking about curbing fuel subsidies, which also fuel subsidy might impact climate change and the poorest in the future. So how do you see those type of policies? Thank you.
Thanks very much. I think it is true that, of course, it is difficult. I mean, there are no shortcuts sometimes to some of these policy options. You have to look at, of course, where you're getting the money. But most importantly, I think, as everyone has said, as Gabriela and my brother Robert has said, you know, how you're spending the money. And I think that that's an important area. And in many cases, particularly in the region that I'm more familiar with, that is the missing link. There's still a lot of work to be done in terms of making sure that, you know, we are aggregating all the efforts to make sure that, you know, the spending, there's return on investment in the spending. We still have a lot of huge infrastructure investments, I think, across the continent, which is a major driver of the reducing physical space because of the huge debt. But I think that the main reason why that is also happening is that a lot of those investments are huge. They don't have return on investment. So that means there's not a very good analysis, I think, before. And sometimes they are artificially also, you know, higher than would otherwise be because of corruption and maybe just technical weaknesses in analysis. So I think that there's an agency there. That's why the place of citizens and civil society is also an important one, I think, across the continent. And I think that that's where we have insisted that we need actually stronger partnerships. If there are going to be conditionalities, I think that they need to be around these issues around the return on investment. So I think that that's where you will have kind of find a lot of partnerships with the African people as well, all the people who are part of this, to make sure that, you know, we are looking at those areas. And I think that many of the areas across the continent, I think that there's a lot of disconnect between where the majority of the people are. For example, in agriculture, that's an area, and food productivity, that's an area that if there's anything that needs to be done, that's where you can actually, you know, expand the income of many households. It may be small, but they're the minority. In some cases, 70–80% of the population. If their productivity can be increased by maybe input support and things like that, then there's a, you know, a trickle-down effect. If it can also be followed up with, you know, a value addition and things like that. We're not seeing enough investments in those areas as well. Of course, there are always going to be short-term and long-term interventions, and one needs to have the balance between those lengths as well. And what you do within the next 2–3 years and what you do over a decade or so, it's important that we have a clear dimension on that as well. And maybe if I may say something on what has been discussed on education, one of the things that we actually need to look at, apart from just the quality, as Francisco was saying, is that in some of the contexts, particularly on the teens, when in some countries like Uganda, where I come from, there was actually a closure for up to 2 years. So there are many people, probably anything between 10–20% of teenagers who are in maybe either in secondary or what, will never come back to school. That means they have moved on and they will not come back. So we have a huge number of people across the continent who are actually lost out completely. And I think the long-term implications of that is going to be, and I think that there might be options to think about, you know, how to engage them so that they are productive what are the TVET programs that might, just to reach out to them, including of course the social aspects of that as well. There has to be deliberate efforts to look at that, because again, 10% of young people in a continent where the majority of the population are actually of that age means far more, I think, in the long term than we can probably see at the moment. Maybe the other thing is, and I think I agree with Robert Osei that physical space is not just in taxation, because taxation can have implications. But I think that one of the areas that we need to look at is also the losses that we get, we lose. And as I said at the beginning, there's a lot of illicit financial flows across the continent. So there's a lot of money that the continent would otherwise be getting that is not being getting. And there are many reasons, including, of course, state capture. The power of some of these big corporates, is such that they have a lot of influence over, the tax policy regimes, or even the structure and, financial, policy options that governments take. And that's why, again, partnership with citizens and finding ways through which governments across the world are collaborating and having more multilateral means through which we're actually restraining these mechanisms through which IFFs are being perpetuated. We have said in other contexts that probably we need to be looking at, global tax policy regimes that make it a bit more difficult for IFFs to thrive. So there's quite a lot of money that is being lost, I think, in the continent as well. And again, as I said, that is partly because of state capture and sometimes collusion between governments and the big corporates.
Thank you.
And I think okay.
Sorry, no, you can finish. I thought you were finishing.
I think you had something. I didn't hear you well. You had about the issue of fuel subsidies. I think that there are many contexts one needs to look at. Subsidies is something that can strike both ways, because sometimes the subsidies could also mean that is a mechanism through which the big oil dealers and the dealers are the ones that are benefiting more than actually the poor people. So I think that there are many things that needs to be looked at into the details of that. But I think the bottom line is that every option has its long-term effects, and there has to be analysis. But most importantly, there has to be a lens of return on investments. Whatever you put, what does it mean on jobs? What does it mean on long-term revenue? What does it mean on inequality? That needs to be something that we look at all times. And they're both, that's what I can say.
Well, thank you, Peter. It's a couple of minutes past 10 o'clock, so we're going to be closing now. I hope this has been an interesting conversation for the audience. I wanted to thank you to each of you who have been talking here, to Gabriela, Francisco, Robert, and Peter. Just to remind that tomorrow we have another session in which we're going to be looking more closely to the experience in Africa, but also in Latin America, and what we have learned. Tomorrow we also will have some Q&A again. So if we didn't have time to ask you your question, maybe tomorrow we can. So thank you very much. Also would like to thank the African Department and the African Training Institute for the possibility of being here moderating these panels. And I think to close, I will go back to Director Singh at the African Training Institute. Thank you very much.
Thank you very much, Rodrigo. I will be very brief. I want to thank the excellent presenters for those deep insights, extremely well presented with the rigorous, explanations of what's going on in the data. I couldn't support more some of the discussions on the policy recommendations. I can tell the participants that having just worked on one of the fragile countries in sub-Saharan Africa, we made sure that we used some of the SDR allocation that the fund had to protect school feeding programs in the schools in Sierra Leone to keep a large number of children in school during the pandemic. And I think that might be one of the most effective type of interventions we could have made in during that period. But I'm really looking forward to hearing more about the country-specific policy responses tomorrow, both from Sub-Saharan Africa and Latin America. I want to thank all the participants. We've had, over 160, 70 people joining us from all across the continent and elsewhere. Thank you for joining us, and I hope this has been stimulating enough to encourage you to come back and discuss policy more and what can be done and the way forward tomorrow. So thank you, everybody, and look forward to resuming tomorrow.